Hi everyone, little bit of tourism for you to get you going here. This is the house where Marylin Monroe lived with Arthur Miller, the famous playwright. Although she said she was not terribly happy during that time in her life, she did enjoy living in Brooklyn. In fact, she said she wanted to retire to Brooklyn, which obviously never happened, but that's the house where she lived with Arthur Miller. Anyway, I have another special request, but let's quickly talk about oil, and I'll show you something else tourist-wise at the end. So basically, we've had some oil field service companies beating, but we still find the companies to be expensive. What we were interested in was Halliburton CEO taking the under on US production growth this year, because that's been the problem, one of the problems in global oil. The others being probably China not coming back as fast as we had hoped, and the sustained production and exports of Russia, which have had some issues obviously in the past few days with the major explosion and attack on a Russian export port, but evidently that port is back up and running, and you can tell where they're making the money. It would be very significant for distillate markets if that port was to have sustained outages, because that's the tightness in global oil, which leaves us actually feeling quite good about oil prices. Essentially, we like this range of 70 to 90 because we think it's not too hot, not too cold. We'll call it the dreaded Goldilocks. And as a result, we're quite happy to see the oils having a bounce here. In fact, we expect to see the oils bouncing here, and potentially a recovery in all cyclical names, as we can't stretch, in our view, these tech stocks a whole lot more, particularly Nvidia. It just seems so stretched right now. We'll see what Tesla does tonight, but obviously Netflix was a one-off, very successful story there for them, and that's getting the Nasdaq going again. But it's notable that interest rates are rising quite rapidly today again, and our general call is that you're going to see more upward pressure on interest rates over the coming year than is anticipated by the market, driven probably by economic strength, and that is going to be positive for the cyclicals and positive for the oils, because essentially we're looking for sustained inflation to be positive for the oils. Amongst the oils, as I said, we don't really like the oil field service names. We just think they're too expensive for what they offer. We've seen significant multiple degradation in those names, and we're just not seeing a reason why they should recover a growth multiple in the way that they used to have back in the day when there was no capital discipline in US E&P. And the bullish thing that the Halliburton CEO said was less about Halliburton in our opinion, but more about the rig count. He's expecting it to go up a bit, but overall activity to remain flat this year. And as activity gets more expensive, if it's international deep water, or more complex if it's more New Mexico and the Permian, so there's an anticipation that he took the under on US production growth this year, and we're generally hoping that that's the case, because if we can get a rollover in US production growth, that'll be bullish for the sector. It'll be prima facie evidence of declining productivity, which ironically will benefit the best companies. And we're still liking Exxon, Chevron, Conoco. Exxon preferred to Chevron amongst the big names that we like. And then, some Permian names which we think will do fine this year. We like the management of Diamondback a lot. Our top pick is Permian Resources. So basically what we're looking for here is a pretty good set of earnings from the big oils. We've had beats from the service companies. There's been a couple of dramatic blow-ups, slightly offbeat. Archer Daniels, disastrous tax fraud questions, which are always a negative, obviously. And then, of course, today we have DuPont warning on petchem, so that will remain an overhang on the group, and somewhat of an overhang for Exxon, Chevron. To an extent, Phillips' earnings results will all be negatively affected by petchems. But the oil price remains at a good level, and these companies have strong buybacks, that we're anticipating to be sustained through the whole of 2024 and beyond, in fact. And if we can see the companies beating here, we now have sufficiently discounted multiples where earnings beats will reflect into higher share prices. And so we're looking for a bounce in the group here as people buy back into what's a fairly sustained good oil price. We're at the lower end of the 5-year band, but things, as I said, are holding together nicely. We've got distillate strong. We had a big draw just now in crude inventories, which is just noise around all the storms in the US. But nevertheless, the market seems fundamentally pretty well supported by general global economic activity remaining high outside of Europe. and sustained cuts from Saudi maintaining pressure on the price not to go a whole lot further lower. So we really see the market as balanced here, and we think on that basis, given the oils are making good money and we're expecting decent results from them, we like the group here relative, while we're watching interest rates carefully, because if they keep going higher, we should take a lot of the heat out of some of these enormous names like Microsoft. Going past $3 trillion of market valuation this morning is pretty impressive. Okay, stay tuned. Okay, I wanted to show you this, which is the Cat Cafe. And there are the cats. Have a great day.